Right now, we think there's a strong potential that stocks and bonds give up some of their strong year-to-date gains here going forward. And the reason for that is there's a significant disagreement right now between what the stock market is saying and what the bond market is saying. Okay, so let's take a look at US stocks. March seemed like a bit of a consolidation month where investors started to digest all those strong gains from January and February, and also digest the outcome of the Fed's March meeting, in which they revised down their expectations for economic growth, inflation, and the path of the federal funds rate. So foreign stocks during the month of March traded sideways, and you had this confluence of positive and negative factors that basically led to them treading water. So we had some good news out of China, where it seems like Chinese monetary and fiscal stimulus may be starting to stabilize economic growth there. We're a bit skeptical about the legitimacy of the data, and we're not alone in that. So we're waiting to see that rebound in data confirmed by satellite indices. But on the negative side, you got some very bad economic data out of the eurozone and increasing uncertainty around the Brexit situation. Right now, there's a significant disagreement between what the stock market is saying and what the bond market is saying. So the stock market is approaching all-time highs with expectations for very low volatility going forward, whereas the bond market is pricing in slowing economic growth and an elevated probability of a recession right around the corner in early 2020. And so our base case view is that the rally in stocks may be a little bit overstretched, and earnings for Q1 2019 are going to have to come in significantly better than expected in order to justify these prices. Whereas in the bond market, the recent decline in interest rates actually has spurred a pretty rapid rise in mortgage activity, which we think could put in a short-term boost to economic growth and actually result in interest rates rising further. So in summary, we think there's definitely potential that stocks and bonds can give back some of their strong year-to-date gains here in the near term.